All right, next one up here. Here's why Apple should be in your portfolio.
Feel optimistic. Is this something that you say, okay, well, I'm going to continue to be a shareholder over the medium and longer term?
Well, I think it's how do you define what Apple is? We know that they're not a business software developer like Microsoft, and they do develop their own chips, but it's not necessarily in the hot area, AI. So what are they, and why should they be in your portfolio? Well, they are the supplier of the platform that gets a whole lot of eyeballs onto things that run AI. And are they going to be displaced anytime soon? And I think the answer is no. One of the reasons why I continue to own this is their unbelievably strong moat. Once you become a user, try not to become a user, right? So they absolutely need to step up their game in iPhone and any of their devices, because they are a device maker, not a software maker. And they need to be the platform of choice to get it into the hands of the consumer. Maybe into enterprise, but mostly into the consumer. And that is why they continue to be in our portfolios.
Kim, why do you think, or as an Apple shareholder, maybe I'll frame it differently, they are shutting down their car ambitions and they're going to shift resources to artificial intelligence? We heard that. They've said it for the record. Are you okay, happier, less happy, sad about the fact that cars are no longer part of the equation and that the resources are going to go towards AI, or not?
I'm thrilled. I don't know why they were in the car making area anyhow, because a lot of it is on batteries. Yes, I get that, and electric motors, but mostly it's in, all car stuff. And I don't think Apple had a whole lot of knowledge about that. And maybe we would have had the prettiest looking car or whatever, most aesthetically pleasing car ever in the history of the world. But as an Apple shareholder, I really didn't care. I'm glad they're back to understanding what they do. And this feels very Microsoft, I don't know, maybe 2014, when they stopped chasing Apple, when Microsoft no longer wanted to develop a phone. And they just understood where their role was in the world, and that is as an enterprise software company. And I feel gratified that Apple is leaving the world of EVs behind and concentrating on what it does best.
That's fair. No objection there. The one thing I'll say about Apple, take a peek at the stock here today. It's been down anywhere 2 to 3%, and something strange is going on there, right? What is going on? So here we have the NASDAQ doing pretty good, S&P 500 doing really good. Those are right around all-time highs. And Apple just continues to show weakness and weakness and weakness. And we know there's consistent week in and week out buying S&P 500, which obviously where does the majority of that money go? It goes into Microsoft and Apple. We know there's always consistent QQQs buying out there. Where's the majority of that money go? It goes into Microsoft and Apple. And so to see Apple so weak like this, and we know Apple's always buying back massive amounts of their shares, to see the stock so weak, it makes you have to ask who's consistently selling the stock day in and day out. And I just have to wonder, is Buffett selling? I just have to wonder, is he dumping a position? Because, he sold shares last quarter, and it didn't even make sense why he would sell unless he just wanted out of the stock. And then to see the stock continue to move down, even in this market that has been pretty good, you got to stiffen that out and be like, well, there's got to be a big seller. If the whole S&P 500 was tanking right now and the Qs were all tanking and Apple's going down with it, at that point you can understand, okay, it's just the market. We're just in that sort of market. But when everything else seems to be doing just fine, and yet Apple continues to just have a tough year, there's something fishy going on there. Fishy. So I don't know. We'll find out. In a few months if Buffett is indeed actually selling more shares of Apple. But it's very strange. Let's hear what Dr. Doom has to say.
Noriel, good morning to you, sir.
Good morning, John.
It's good to see you. I was reading through some of your work, and I have to say, it didn't seem like you were worried about too much in this economy, in this market. Is that right?
Well, I'm less worried than the past. I think a year ago, people were worried about a hard landing. Then they started talking about the softish landing with a short and shallow recession. Now people talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky. And actually, of all scenarios, the one that is more risky for the market compared to a soft landing is a no landing, because markets were pricing in 6 rates cut by the Fed earlier this year. Now they converge to what the Fed is telling us, only 3 cuts. But what if growth is well above potential because of technology or other factors, and then the Fed doesn't cut 3 times, only 2 or 1, maybe some people say 0. Last year, revisions of expectation about the Fed in August and September led to a 10% correction of equity. So I think that's potentially, paradoxically, that good news on growth may be bad news for the market if that implies the Fed is not going to cut as much and as soon as people expect now.
So just to put it in a headline, Nouri Arabini thinks the biggest risk is upside risk.
Right now, yes, because the data on Q4 suggests the growth well above potential, and even Q1 suggests that maybe growth is going to be around 3% plus. We're not having a landing of the economy in spite of the Fed cutting rates.
So just to put another headline in this, even Nouri Arabini is optimistic. I mean, we're looking right now, people looking for reasons to kind of gut check.
Well, let's be clear about this in regards to this man, okay? He's kind of being optimistic and pessimistic all at the same time. It sounds like, if anything, he's a little optimistic short term, right? Numbers can come in better than expected, and the Fed doesn't have to cut as much or as fast, but that could potentially lead to problems in the market, right? Where the market looks out there and they say, oh my gosh, wait, the Fed's not cutting. We thought the Fed was going to cut 4 times, 6 times, however many times this year, right? And, it's just, the can might be kicked down the road a little bit here in regards to cuts. But we'll see. I mean, inflation numbers are looking pretty good. You look at the trueflation data, it's looking very, very good. So anyways, the moral of the story is inflation's still looking pretty good. If commodities go on another big bull run, we're screwed.
A runaway record rally that we've never really seen in this kind of environment. And the gut checks aren't coming. Does that sort of give you pause, or is this basically a new paradigm where the artificial intelligence, the whole idea of productivity, that you're buying it?
Well, there are several things. First of all, last couple of years, inflation fell without growth slowing down sharply, in spite of Fed tightening rates. And in my view, not because of what the Fed does that push inflation lower. We got lucky because there were 3 negative aggregate supply shocks post-COVID that led to lower growth and higher inflation, and they were reversed. The impact of COVID on labor supply and production of goods and services, the impact of the Russian invasion of Ukraine on commodity prices, and the zero COVID policy of China. These were negative supply shocks that were reducing growth, increasing inflation. Those went away, and that explains why you had still high growth and lower inflation. So it was not the Fed job that did it. It was just we got lucky. And on top of these 3 positive aggregate supply shocks, now we have a 4th one that's actually much bigger and secular. This is the AI revolution, this technology revolution that probably over the next decade, not this year, is going to increase productivity growth, is going to increase potential growth, is going to increase economic welfare, and is going to reduce cost of production. So I think that's what the market is reacting to.
That's fair. And yeah, I think the good point he makes right there is, I hope you guys picked up on that, right? He said over the next decade, maybe not the next year. Everybody wants all this productivity and all these gains for the economy to all happen like right now. And it's like, this is a process. Like it's going to, it takes a while, for all these big mega trends to catch on and then actually start to matter significantly out there. Markets are approaching a little euphoria.
NVIDIA's of this world, the top performers of the last 12 months?
Yeah, I think you can certainly lighten up your equity exposure overall. I mean, I would take it first from small cap, which has been, a relative underperformer, battered and bruised. But I think you do have to lighten up. If you
lighten up in small cap, I mean, then it's just an incredibly, incredibly bearish stance. Yeah, it's just very bearish. It's not like small caps have done anything amazing. Extremely bearish.
Enjoyed 24% return over the last 4 months, which is what you've gotten November, December, January, February, 4 months, right? That is impressive. You'd be wise to take a little profit there.
Yeah, but I can also point out specific time periods. Well, over the last 8 months, IWM's only done this, and I mean, we can all play that game. That's a silly game to play.
Conversation you were having earlier. Remember and recall, sage words, wisdom says bull markets die in euphoria, right? To the point, there is no downside that anybody sees at this point. We are starting to approach a little bit of euphoria here, and I think you have to set that context correctly.
Let's get into that word, euphoria. So Savita Subramanian's come out over at Bank of America. She's gone to 5,400 from 5K. She says any signs of euphoria are thematic and secular. So we're talking about AI, NVIDIA, we're talking about GLP-1s, we're talking about Novo Nordisk. Outside of that, where are you seeing what you would describe as euphoria?
I think you're seeing it in, you're definitely seeing it in technology, you're definitely seeing it in consumer discretionary, you're definitely seeing it in comm services, all the leaders that have continued to lead. For markets to really make that next leg higher, you've got to have three things happen, right? You've got to
Hold on, before he goes further here. Are we really seeing it in technology? He says we're seeing it in technology, right? We've got a divergence in regards to tech even.
Breadth widen out, right? Narrow markets die painful deaths, right? I mean, 2023 was the narrowest market only to 2007. We know what happened in 2008, right? And if you go back and look at other narrow markets, 2020, 1999, 2021. Remember 2021 to 2022, what happened in 22? Big negative returns. What happened in 1999, in 2000, right? So narrow markets don't sustain that leadership. History teaches you that lesson over and over again. So you need breadth to widen out. You need earnings to participate. Better fourth quarter numbers, right? We'll take the earnings growth. But think about it this way. If companies, even large cap companies, if their wages are still growing 4, 5, 6%, right? But their top line, we just saw the total sales number grow at 3, let's call it. I can't have my biggest expense line as a company CEO or CFO growing at 4 or 5% and my top line growing at 3 without starting to lay people off, without starting to roll the economy over in that sense.
Yeah, that's fair. That's fair. I can't debate that, okay? Alrighty, next one up here. Fed Powell. This has market implications here.
Waters and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year,
which is good and bad. So it's good in terms of wage inflation, right? But the one thing I will say is could get scary, and this is more 6 months, 12 months down the road, is if you look at job openings, the number has definitely been plummeting. Now, one of the reasons we haven't seen massive unemployment in this Fed hike cycle yet, right, is because we went into this Fed hike cycle with not just a record, but by far and away a record amount of job openings. And so as people maybe lost jobs in certain other industries, right, they've been able to find jobs in other industries. Now, the scarier thing is if job openings continues to, let's call it, decline month after month for the next, let's say 6 to 9 months, then at some point in time, when people start to lose jobs in the future, let's say a year from now, they're not going to be able to find another job right away like they could over the past few years, right? Which could lead to, potentially unemployment starting to go up and up and up. And then it kind of had the dominoes start falling the wrong way. So it's something that's definitely worth keeping an eye on, a very close eye on over this next year is job openings. Okay, it's the whole reason we haven't had the big unemployment cycle yet. But if that number keeps going lower and lower, then we're going to have a problem, because then when people lose the job for whatever reason, that company goes under, it's just not going to be nearly as easy to find the next job there, right? Or if you can find a job, it's like pays dramatically less than whatever your old job was. So just a little food for thought regards to that.
Payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor,
which is good and bad. It's bad because that means there's still going to be some wage pressure, right? Which could also be looked at as good because you want people to make more money, but then you talk about wage price spiral, that whole situation. But it's also good because that means we're still in a place that if somebody goes and loses their job for whatever reason, or a company goes under, that they can go find another job. There's another opportunity out there.
For the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups.
I know not everybody here, might have went through the great financial crisis, but as somebody who was entering the workforce in the great financial crisis, it was brutal to get a job. And not only was it brutal to get a job, I was happy to just get jobs that paid above minimum wage. Like I was thrilled back in 08, 09. But not only that, you also had, a lot of my assistant managers at Walgreens were college graduates that were assistant managers at Walgreens making $35,000 a year. And that was the best available job to them back in 08, 09, into the beginning of 2010. It was a very tough jobs market. So, when you're talking about college graduates that went to business school and, are working as assistant managers making $35,000 a year, which nowadays it might be $45,000 or $50,000 a year, you're in a really bad job market at that particular time. And so, just to understand the levels of how bad things were at that particular time. Like people with college degrees with $40,000 and $60,000 in student loan debt were happy to make $35K as an assistant manager at Walgreens. Man, that was tough times.
Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022. It was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective.
So he made sure not to signal at a specific time this year. He's just saying at some point this year, right? Which I think is a very important statement, to not try to signal, soon or in the next few months or in the first half of the year, second half. He just left it open. Very intelligent decision by Jerome Powell there, in my personal opinion.
For inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%.
Yeah.
At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
Which is better it's a better outcome, actually. It's the better outcome of the two. The worst thing you want to do is start loosening up rates. Inflation comes back. You got to come back in like the 1970s, start raising rates again into a much weaker economy where the jobs market is not nearly as strong and robust in terms of job demand. That's when all of a sudden you get a big unemployment cycle that hits hard, and that's brutal. So, yeah.
Adjustments to the target range for the policy rate. We will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
So, when's the Fed going to lower rates? If you had to put me on there, when's the Fed start cutting rates? My opinion is the Fed starts cutting rates sometime between May and July. That's my personal opinion. Sometime between May and July, the Fed starts lowering rates. Now, keep in mind, they're likely only going to lower like 25 basis points at first. It is almost irrelevant. It's just about the signaling of like, we're starting to lower rates, right? We're starting to lower rates. So that is what it is. It's also not always the best sign when the rate cut cycle starts. A lot of people are really excited about when that actually is going to come, whether it's May, June, July, August, September, whenever the first time. And, I don't know. I'm going to get more nervous when the Fed actually, that day, the Fed actually cuts rates is a day that I get a little more nervous, actually, rather than excited, versus a lot of people are all getting really excited about that. I get a little more nervous because a lot of times when the Fed starts cutting rates, it means bad things will be coming down the pipe for the economy. And so that's why I've been in no rush, as I've told you guys many times, for the Fed to start lowering rates. In my personal opinion, I think it's usually a bad omen. So I don't know, man. We'll see. We'll see how it all transpires and works out. But yeah, that is what it is, okay? Appreciate y'all joining me as always. Thank you so much for being here. Make sure you get my free new workshop down there. That's pinned comment, how much money you need to retire, quit your job, focus on investing full time, all that good stuff. Much love and have a great day.